In this presentation, we're going to continue on with the comprehensive problem recording the transaction on the end of the month, on the end of January, January 31st of dividends declared, and then we're going to pay the dividends. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Now, note that the dividends are usually more of a bureaucratic process, meaning we have to decide when to make the dividend. We have to decide when who's going to own the stocks at the point in time that we're going to distribute the dividends to those individual people. And then we've got to pay the dividend. We're going to record the two actual transactions at one time. That middle one isn't a transaction, meaning we have to determine when that we're going to have a dividend. That results in a transaction. We have to determine at what point in time when people own the stocks are they going to get paid, meaning people can trade stocks all the time. If it's a publicly traded company, people will trade stocks a lot. The question is who has to have ownership at what date in order to get the dividend that we're going to pay at some point. And then, of course, the dividends that we'll pay in the future will actually pay the dividends. And note, this should be $1,500 that we're going to pay for the dividend. We'll record the two transactions, the declaration and the amount of payment, just as of the same date so we can see the process of the recording. We also want to just relate what the dividend is and get a better idea of what it is. How does a dividend relate to like a sole proprietorship or partnership? What are the similarities and differences of a dividend? So that's what we'll talk about here. So if I go to the right, we could see our trial balance, and we got the assets, liabilities, equity, income, and expense. What does it mean that a dividend has been declared? Well, a dividend just means that we're going to pay the stockholders. So we're going to pay them, in this case with cash. It's going to be a normal dividend rather than stock dividend. But we're not going to pay them right now because of that bureaucratic process. We're going to say, hey, our board of directors, we've decided to give a dividend. Now, if you compare it to a partnership, you might say, well, that seems kind of weird. Like if I'm a partner and I go to a partnership and I say, hey, I want to draw some money out because, I need to pay some personal bills here, then the partner has a lot more leeway within the constructs of the partnership agreement to just take out money, and we call that a draw. But a corporation, there's going to be more problems. The owner of the corporation, if it's publicly traded, can't just pull out money typically. Even if it's a privately owned company, we still have to go through the process of problems with a corporation, which is that all stocks are the same. So for example, if one stockholder, even if they own 51% of the stock and therefore have complete power in terms of voting rights and whatnot, says, hey, I want to pull out some money for my personal expenses. The company makes money, so I can pull it out for my personal expenses. We still have a problem there because they can't just get a dividend or a draw for their 51 shares. Once we determine that there's going to be a dividend, every stock gets the same dividend that we declared to give. So for that reason, dividends are a little bit different than draws, meaning we can't give a different dividend to different owners as we can with a partnership. We have to decide that if we give a dividend, we give an equal dividend to all stockholders. And that's could be a pro and a con of a stock. That's what makes the stocks all the same. That's what makes stocks really tradable, or one component that makes stocks really tradable. But of course, that means that the only difference in how much each person gets in terms of dividends is determined by how many stocks they have, rather than deciding, tracking individuals' capital accounts and deciding how much they can pull out. So that's kind of the difference here. So dividends, if you compare it to a partnership, is similar to a draw, but there's more restrictions to the dividends than there are draws. But in essence, for journal entry purposes, pretty much the same. We're going to reduce the capital account section, or we can have a contra account, or we can just take it out of retained earnings, and the other side is going to eventually be cash. However, if we asked our first question, is cash affected? Not yet, because we only declared the dividend. We haven't yet paid it. So what we're going to do is say, hey, well, we declared it, we owe something in the future, and therefore we have a payable. So we're gonna say that we incurred kind of the dividend right now because we've decided on it. It is what it is. It's kind of written in stone. It's going to happen. So we're going to say at this point in time, the company owes its owners, stockholders, money Therefore, the company, the separate legal entity here, and the separate entity just for bookkeeping, is going to record a liability for that payment that is owed in the future. So we're going to right click and copy the liability. Liabilities have credit balances. We're going to put that on the bottom because we're going to increase the liability. So in H24, right click and paste 123. The amount's going to be a negative 15,000. And then we'll debit 1,500. And then we'll debit 1,500. I'll say negative of this number to flip the sign. So we could just type it in there. I like using formulas. I'm going to increase the indenting here by going to the Home tab. Alignment, increase indenting. You probably have that on yours already. Then we just need to know what the debit will be. Now I've broken out dividends into a separate account just so we can see it, and then we'll close it out in the closing process to retained earnings. You can see or sometimes it might just be taken straight out of retained earnings. But in any case, we're going to decrease the equity section. So I've put it here like we would see if we had draws. It's similar to draws. It's going to be a contra equity account. Equity accounts having credit balances. We're going to do the opposite thing. Draws going up with a debit rather than a credit. So we're going to copy the dividend, right click and copy, and paste that to the debit side in H23. So notice what happened here. We incurred a liability, kind of, right? We're on ourselves. The company basically said, I'm going to have a liability, not because we got anything. We don't have an asset that didn't go up, and we didn't get any expense that helps us to generate revenue. What did go up? The equity section. Why do the liabilities go up for the company? Because the company is a separate legal entity and has made a commitment to take some money out of the company at some future date, pay it to the owners, the stockholders. So it's not going to affect the income statement. It's only going to come out of the equity section. So let's post this first, and then we'll take a look at the other side. I'm going to post it without freezing the panes so that we don't have to freeze and unfreeze, but I want to see this as we go. So here's the dividends. We'll do some scrolling this time. Here's the dividends. It's going to be in the middle of the equity section. Same order on the trial balance. So I'm going to scroll to the right. We got assets, liability, equity. Here's dividends. So here's dividends. We want to be on the debit side. So dividends, I'm in AE21. And what I'm going to do is do some scrolling this time. So we're going to say equals, and I'm just going to scroll. I'm just holding down or just using the arrows. I think is easier to use. You can also use the scroll bar down here, but I'm just using the arrows till I find my journal entry. We want the last journal entry. We want to pick up that dividend and enter. So that's how you do it with scrolling. I'm scrolling to the right just so we can see it. There it is. And it's equals I-23. So it went up from 0 to 1,500. If we scroll back over, scrolling left to the trial balance, we'll see the 1,500 increase here. You notice it's a contra equity account, all other ones having credits, this one being a debit, bringing it down. Total equity, bringing total equity down. And we're out of balance by that 1,500. Then we have the dividend payable, which is going to be our last liability account on the trial balance. It will be the same for the general ledger. We're going to scroll right. And here's our dividend payable. I'm just going to scroll so you can see it right there. We want to be on the liabilities or on the credit side because the liability is going up with the credit. We will say equals, scroll to the left to find our journal entry that we need to post there. So here it is, dividends payable. We want to pick up that 1,500 credit and enter. So there we have it. It's going up from 0 by 1,500 to 1,500. If we scroll back to the right, back to the trial balance, we see that dividend payable here. What happened? The liability went up and the equity kind of went down. Dividends went up, but it's a contra equity account, bringing the equity down. Remember that equity represents what is owed to the owner, 118,100. It went down because we declared that we're going to pay out some of it to the owner. Therefore, what is owed to the owner goes down, or assets minus liabilities went down. Now we're just going to go ahead and pay it at the same date just so we can see the transaction, the full kind of dividend process at the same time. So what, and I should have put 1,500. We're going to pay the entire thing. We're not going to pay part of it. So we're going to pay the 1,500. So at the future point, typically we would then pay it. It might happen at the, we could have it if it's a small company happen, kind of at the same time. But if it's a large company, we'd have some future date. but I just want to see both transactions here. So now, of course, we have this payable, and we're gonna pay it. So now we're just gonna pay it out. Here's the cash. We're gonna make it go down because we're gonna pay out the dividend. So we're gonna copy cash. Scroll down. We're gonna be at the bottom. So underneath the date, in cell H27, right-click and paste 1, 2, 3. Then we'll go to the Home tab, Alignment, Increase Indenting, probably already done for you. We're going to credit it for 1,500. Again, this number should be 1,500. And then we're going to debit 1,500, negative of this number. I like to use the formula. And then we're going to decrease the other side. We already recorded the dividend. We're going to decrease the payable now. So now we're going to pay the dividend, right-click and copy the payable, and put that in H26, right-click and paste 1, 2, 3. Now we'll post this out. So here's the dividend payable. It's going to be our last liability on the trial balance. It'll be the same on the general ledger. So if we scroll to the right, looking for dividends payable, we see it here. And so here's dividends payable. Scroll all the way to the right. We'll just do it with scrolling. We want to be on the debit side this time. So we're in AA23. We're just going to say equals and scroll to the left. I'm just holding down the arrow. I'm not pushing the arrow multiple times, the left arrow. And then here's the 1,500 and enter. That'll pull it back over here. So we increased the liability and then we put it back down to 0. And that's where we're at now. This cell is I23. I'm just scrolling to the left with the left arrow. Next we have cash. So here's cash. We can see our dividends payable went down to 0. We're out of balance by 1,005. Going to cash, and we're going to pay the cash. So we're in P19, where we will say equals, point to that cash, 1,500. It's going to go down from 37,600 by 1,500 to 36,100. What's the effect on our trial balance on all the accounts? The effect of both of these is the same as you can think of as a draw for a partnership or sole proprietor, meaning cash went down and equity went down. We just call it dividends. So again, when the bookkeeping for it is really pretty much the same as draws, except that you typically have a two journal entries that you need to record because the date of declaration will be different than the date that the actual dividend will happen. Oftentimes, if it's a large company, for sure, because it's just that bureaucratic process that will happen. And then when you think about dividends, however, you just got to think about it a little bit differently, because no owner, can typically go in and just say, I want part of my capital account back, as you can with a partnership. Typically, you can kind of say, the partnership's owed money. I want to reduce my capital account and get paid, take some money out of the company. In terms of a corporation, you have to do it more of a collective way. That's the difference between a dividend and a draws. You got to say, okay, we're going to declare a dividend. Everybody who owns stock is going to get some of that dividend. And so when you make the decision to give out a dividend, it can't be just affecting some owners. It affects every owner. It affects every stockholder who will receive some portion, even if it's just one stock that someone owns. You can't just say we're going to give the dividend to all of us and not give that one stockholder their portion of stock. That's the nice thing about to be a small owner of a corporate stock. You could you still get paid based on those rules of what dividends are and what corporations must do when paying them. For more accounting information and accounting courses, visit our website at accountinginstruction.info.